Hello, welcome to the Capital Employed podcast. For this episode, we had the pleasure of being joined by Adam Rackley from Cape Wrath Capital. In this episode, Adam discusses his background, his value investment strategy, red flags he looks for in the company's accounts, 2 stocks he's bullish on, and key lessons he has learned from over 20 years of investing. Before we begin, every so often we will be doing write-ups about stocks from around the world that have piqued our interest. These will be mostly smaller companies that go under the radar of most financial media. So if that sounds like your cup of tea, visit capitalemployed.substack.com and add your email to the list. That's capitalemployed.substack.com. Okay, let's dive into this week's episode. Please enjoy my conversation with Adam. Hi Adam, thanks for coming onto the podcast. Could you provide a brief introduction to yourself and Cape Wrath Capital?
Of course, yeah. Hi, John. Thanks for inviting me on. So, aside from a brief stint in the army, I've always worked in and around equity research and fund management. So, I've been in the investment industry, I guess, for pretty much the last 20 years. I started off on a graduate program with a global growth investment trust that at that time was based up in Dundee. So, I did a couple of years with them and finished up as an analyst looking at the oil and gas and resources sectors. It was kind of an office full of nice people with lots of experience, but it was a firm which had very little by way of clear investment philosophy or process. And so as a kind of young buck trying to learn the ropes, it was a really difficult place to grow and develop. So I moved down to a firm called Montanaro Asset Management based in London, and the setup there couldn't have been more different. So very clear investment philosophy, very clear process, fantastic place to learn. And I spent the next 4 or 5 years at Montanaro managing, first of all, as an analyst, and then managing a UK and European income fund, along with some segregated mandates. I left Montanaro in 2010, summer 2010, and I had a kind of bucket list of things I wanted to do. So I had a couple of adventures, wrote a book, lectured in finance, got married, became a parent, set up a financial training company. My wife and I moved to Mumbai for 18 months, where I worked for an outsourced equity research firm over there. And then we moved back to London in 2015, and in 2016, I set up Cape Wrath, and that's the firm that I've been running since.
Your background is quite fascinating, and I believe you've also rode the Atlantic as well. Is that correct?
Yeah, yeah, that's right. That was 2010. Yeah, a friend and I rode across the Atlantic. Yeah, it took us 11 weeks, 77 days, and it's funny. We kind of had this idea before we went off that it would be a bit like Chariots of Fire meets A Perfect Storm, this kind of incredible, heroic endeavor against the sea. But in the end, it was a bit more like Groundhog Day, to be honest. It was, you're kind of rowing for 2 hours, and then you've got a 2-hour break to eat and get some sleep. And you just repeat that 2-hour shift pattern, 24 hours a day until you get to the other side. So it's pretty grinding, and it's pretty, it's as much a mental challenge, I'd say, as a physical one.
Yeah, I can imagine it's very physically and mentally demanding. In regards to Cape Wrath Capital, what type of businesses do you like to invest in? Are there any specific characteristics or situations you look for?
Yeah, so I mean, we Cape Wrath Capital, we have what we call a differentiated value strategy. So we target pockets of analytical and behavioral inefficiency in the form of capitulation events and narrative shifts. And in a previous life, I've been a quality growth investor, and there we definitely targeted a specific type of business, cash generative, kind of growth company, dominant position, niche market, high return investment, all those kind of things. But actually, as a special situation deep value investor, it's more the situation rather than the type of business itself that we're targeting. So we are essentially looking for 2 things. We're looking to enter on a capitulation event. And we're looking for a situation where we believe there is the opportunity for a narrative shift, what we call a narrative shift. We define a capitulation event as a situation where existing shareholders are exiting for emotional rather than analytical reasons. So you might have a company that has had a series of profit warnings over a number of years. It might be a stock that was once a kind of fitted a kind of quality growth profile, but no longer does. And it could be that it's kind of become a de minimis part of the investor's portfolio. And they are kind of tired of answering questions about it. It's taking up a lot more kind of emotional bandwidth than it should, given its kind of small position size in the portfolio. And there comes a point where they decide that they just want to get it out of the portfolio. They're sick of having awkward questions about it. It doesn't fit their quality growth profile anymore. And although there might be plenty of upside to the stock, it's just not worth holding on to it. For us, those capitulation events can provide ideal entry points, but of course, the biggest risk facing a kind of deep value investor is a value trap. So we do a lot of work to try and understand the fundamentals of the business and to work out whether or not there is a decent business kind of underneath that provides the opportunity for the second thing we look for, which is a narrative shift. The way we look at things, there are a lot of different narratives in the market, be they narratives on the part of owners of the shareholders in the business, or short sellers, or analysts following the company, or the management team, or narratives in the press. And at any one time, one of those narratives will be dominant, and that will be essentially driving the multiple, driving the valuation of that business. And we're looking for situations where we feel that there are a small number of events or catalysts that could cause that narrative to shift, to drive a re-rating to what we believe is the fair, or what we call the approximate value for the business. So those are the types of situations that we look for. And I draw the distinction between, looking for a certain situation as we do versus looking for a certain type of business, as you might do if you're a quality growth type investor.
You mentioned there some of these stocks, they are cheap, but they're not always the highest quality. They might have a few problems. Are there any red flags perhaps buried in the accounts you sort of look for when doing your analysis?
Core of our investment process, when we decide to do a deep dive on a stock, we complete an initiation. And the initiation is a list of, it's around, these days, probably around 95 questions divided into 12 sections. And those questions are all basically trying to kind of poke holes in the company and identify, what the risk factors are. A lot of the work that we do is around understanding how robust the cash flows are. So, in terms of red flags, we'll look at we'll look at the components of working capital, so accrued income and deferred income, for example, and how those relate to revenue recognition. So, it is relatively easy to, or put it this way, there's a lot of subjectivity in how a company recognizes its earnings, and so it can be relatively easy to manipulate those earnings. Cash flow is harder to manipulate, but it's still possible to manipulate cash flow. So you can do things like factoring, for example, to make your cash flow in one period appear stronger than it actually is. And you can stretch out your payables or stretch out your receivables in order to kind of shift cash flows from one period to another. So we spend a lot of time looking at the components that make up free cash flow, any trends that could indicate the management's trying to juice the earnings or perhaps to boost the cash flow in any particular period, and then what that means for a company's net debt position. So you could have a company that on the face of it looks like the balance sheet's in relatively good shape, but actually once you unwind all of the working capital, you find that's actually got a huge amount of debt on the balance sheet. A great example would be Thomas Cook Group, which obviously went bust a few years ago. And at the end of the kind of year end, just before they went bust, it looked like they had, I think it was like 80 million of net debt on the balance sheet, which was tiny for a business of that size. But actually, at the point at which they went bust, they had over $1 billion of net debt, and that's because of the working capital cycle at a holiday business like Thomas Cook, where they take your deposits on your holiday in advance, say around kind of Christmas time, before the busy summer season, holiday season, but they don't pay the hoteliers until the autumn time. So they have this massive working capital flow. So depending on at what point during the year you look at the business, it could appear that they've got loads of cash, or they've got a large net debt position, and the balance is made up by the working capital, so the cash they get in from their customers and pay out to their suppliers. So yeah, we spend a lot of time looking at how kind of cash flows unwind, because particularly if you're considering companies that could be in a position of distress, or where the market is anxious about them, then it's important to get comfort on those risk factors.
I'm fascinated by your portfolio. Looking through it, you've got some really interesting businesses. Many are on Ps of 2, 3. Are there 2 stocks that you are very bullish on for the long term? And what was your thesis for investing?
Yeah, sure. I mean, it's an interesting question in that you ask kind of stocks we're interested in for the long term, and again, if we were quality growth, I think there are lots of kind of heuristics in our industry around what constitutes a kind of proper way of investing. And one of them is precisely that, kind of proper investing is about investing for the long term. The whole Warren Buffett thing, my ideal holding period is forever. But actually, we every time we look at a company, we come up with a clear idea of what that business is worth, which we call our approximate value. And if we can achieve that approximate value within a shorter time frame, then that's better for us and our investors. That's a more successful outcome if we have a 6-month holding period rather than a 6-year holding period. To answer your question more directly, that there are some situations where we invest in companies and the company has fantastic kind of earnings upgrades, and actually our holding period might extend because our approximate value keeps on increasing in line with those increased expectations. And a good example of that would be a company called Somero, which I can talk about in a bit. At the other end, you've got companies where we have an idea of what the business is worth, and it may be a more mature business, or maybe in a more mature industry, where we're not expecting significant earnings upgrades over time. And so our holding period may be relatively shorter because we see a shorter term catalyst, and we don't expect our approximate value to increase. And so we're looking to exit, in the shorter term as it hits that catalyst. And a good example there might be EnQuest, the UK North Sea oil and gas company. So kind of diving into those, two examples. I mean, take EnQuest to start with. You mentioned there are companies in our portfolios with 2-3 times P's. Well, EnQuest is just such an example. It's trading on a P of about 1.5 times. It's trading on a free cash flow equity yield of around 70%. It is oil and gas company focused on the UK North Sea and Malaysia. It has a strategy of targeting mature oil fields and putting in place increased oil recovery, so trying to kind of squeeze the extra barrels out of these more mature fields. Across the world, average reservoir decline rate is probably something like 8%. So if you kind of don't add extra fields, if you don't do kind of tiebacks and enhanced oil recovery, then that is the natural rate at which your kind of oil production is going to decline. It's a bit higher in more mature basins like the North Sea. So EnQuest's strategy is really to try and put in place techniques to kind of reduce those natural decline rates and get the most they can out of these mature fields. Now, obviously, oil is a pretty unpopular sector. We took this position. We had invested in EnQuest in the past, but most recently we took position in EnQuest in 2020 during COVID. Oil futures in the States briefly went negative, and the market could see no reason to invest in all companies. So these things were trading at very low valuations. Now, EnQuest is still trading at a very low valuation. It's interesting, talking about different narratives. I was looking at a popular retail investment magazine over the weekend, which features EnQuest in it, and it's got a few paragraphs which basically read like a buy case, and then the end of the final sentence, it says, but the total debt overhang still dwarfs the market cap. Recommendations sell. And I thought that was really interesting, because that illustrates really nicely one of the narratives in the market that could well be, driving the share price for EnQuest. And this is a perception that it's significantly over-levered. It's got too much debt on the balance sheet, and on the face of it, that's a fair point, because EnQuest has got about 800 million of net debt, $800 million, that is. Market cap would be around half £500 million, maybe 600 million pounds, something like that. So it does have a bigger net debt than its market cap. But interesting things to note. First of all, that market cap is only 1.5 times earnings, and secondly, the company is trading on a 70% free cash flow equity yield. So it just recently reported their first half numbers. In the first half of the year, they generated about $350 million of free cash flow. So EnQuest is going to be debt-free, should be debt-free in under 2 years, call it 18 months probably. And so that's a really powerful trigger for the bear case that this is a company that's overlevered, because in 18 months' time they're going to have no debt at all on their balance sheet, and they're going to have a big question as to what they're going to do with the 70% free cash flow yield. What are they going to do with all this cash flow they're generating? We apply some very conservative valuation metrics when we're trying to value EnQuest. We basically assume that we're going to harvest cash flows over the next 5-6 years, and then whatever's left of the business is going to be worth very little, which is I guess a conservative way of valuing what is a mature industry. And on that basis, we see easily in excess of 100% upside here. But EnQuest, as I mentioned, is an example of a stock where we're not expecting a run of upgrades to continue driving our fair value higher, but where we see a strong catalyst that should drive a narrative shift. Another example of a position in our portfolio would be Somero. So Somero is the market leader in the manufacture of laser-guided screeding machines, which is a machine that you would need if you wanted to lay a very flat concrete floor. So the market for this is in laying very flat floors for warehouses, for example. So there's a kind of e-commerce growth angle. And in North America, actually, a lot of roads are concrete rather than tarmac. This created a really nice opportunity for us when we entered the position around October 2019. So the shares had fallen around 50% over the previous 9 months or so, off the back of a very wet, well, I think it was the wettest summer on record in North America, which basically meant that over the kind of summer concrete laying season, the specialist contractors were unable to lay any concrete. And so this reduced demand for the kit, which is what Somero manufactures, and also for the kind of maintenance and service, which is what Somero also provides. So the shares fell 50%. The market took this seasonal impact and extrapolated it and imagined that the company was, the growth and profitability were permanently impaired. So we picked up the shares just below £2 in October 2019. Since then, the shares have doubled, but they're actually about 30% cheaper than when we bought them, because the earnings growth and the earnings upgrades have significantly reduced the PE ratio. So we still see a significant opportunity here for a re-rating. I mean, Somero is a fantastic quality business. They generate return on invested capital of around 65%, which is challenge anyone to, find me an industrial business with a high return on invested capital. They've got EBIT margins of around 35%. Similarly, it's absolutely incredible, top percentile type EBIT margins. So this is and they're a market leader with kind of long term, having delivered long term growth and with a significant market opportunity. So it's a high quality business trading on a single digit multiple that could easily trade on 2-3 times the multiple. And as I said, they've enjoyed significant earnings upgrades over the time that we've owned them. So that's a stock which has been a longer term holding for us, and we could hold it for a much longer period if our approximate value continues to increase.
I'm just getting maybe the feeling that what's keeping it maybe a bit suppressed is just that fear of the rising interest rates and what that does to the construction industry.
Yeah, absolutely. Yeah, I mean that's a great point. So that is the bear case on Somero, is that they are tied to they're kind of leveraged to the construction, non-residential construction sector, and that you would expect declines in their revenues to be much higher than the declines in the in the construction sector as a whole. I mean, if you wind back to 2009, last time there was a very significant crash in the construction sector in North America, it had a material impact on Somero's revenues, but they remained profitable throughout that period. So, I mean, it's absolutely fair that there is, for this company, as for many companies, some kind of weaker environment ahead. But I think, as the company has significant net cash balances, and they're well positioned to weather the storm, and probably to remain profitable through whatever kind of circumstances unfold.
And it's providing a great dividend as well. Thanks for sharing those two companies. We're getting close to time now. I just wanted to ask you though, if you could go back to when you first started investing, in hindsight, is there anything you would do differently with the knowledge you have now?
Yeah, that's a great question. I mean, I'm always learning, John. Every day there's something new, and that's part of the beauty of this industry and this career, I guess, is that there's always more to learn, and the environment itself is always changing. So it's not like there's a kind of fixed textbook. Actually, you kind of adjust your expectations and how you think about the market and the world. You adjust it every day as things change. I mean, I love investing because it's a way of thinking about the world. And that's the really fascinating thing. So, I mean, there's been, every day is a learning day. I think, one kind of important thing that most all maybe investors go through is that transition from thinking about, what is the return I can get on this, to, as you kind of develop, actually, what are the risks that I'm taking to get that return. I think that perhaps as in earlier days, I might have been more obsessed with finding companies where I saw 100-200% upside, but actually I'd be much happy to take a company with 50% upside but significantly less risk attached to that. So I think that's an important part of the toolkit that you kind of develop as you go, is a kind of a framework for balancing the risk against the return, and trying to understand how that should be calibrated. The journey I've been on as an investor certainly isn't a linear journey. So it's not a question of moving from a position of ignorance to one of knowledge in a straight line. I think it's you could, because you're operating in an environment where it can be you've got to work out from your successes and your failures what was down to luck and what was down to judgment, and it's easy to it's a natural instinct to say, well, everything bad that's happened is down to bad luck, and everything that's good that's happened is down to good judgment. if you do that and you're not aware that you're doing that, then you can easily learn the wrong lessons. And so I think it's important, if you're going to continue to grow and develop in this industry, to spend a lot of time trying to pick apart what you've done, good and bad, and trying to work out how much of it is due to your process or your intuition or whatever it is you're using to invest, and how much of it is just down to luck or things over which you couldn't have known beforehand, or information that you didn't even consider when you were making your investment decision. And I think I've probably swung, moved. There's certainly a point in my career when I was very focused on kind of systematizing my process and trying to take intuition out of it. And I think there was probably a point where I swung too far that way, and kind of had to kind of move the balance back a bit and recognize that the human brain. I mean, there's a big thing in behavioral investing about trying to ignore your emotions and kind of follow your process, and I definitely agree to that up to a point. But I think what you have to remember is that your conscious mind can digest a certain amount of information, a certain amount of bits of information every second, but your subconscious mind is many thousands of times more powerful than your conscious mind in terms of its ability to digest information. You think about all the things that you're doing subconsciously just to live, every day, and compare that with the small number of things that you're able to hold in your conscious mind at any one moment in time. And it's exponential difference. And so I think that the real key is to be able to acknowledge your biases and harness your intuition. And so there's certainly been a non-linear journey that I've been on, over my career to date, in terms of understanding. Long answer to your question, John, but yeah, it's a fascinating,
constant learning
wonderful
process, isn't it?
Absolutely,
the journey never ends
absolutely.
with investing.
Absolutely, yeah.
Okay, where can listeners go to find out more information about you?
I guess our website would be the best place to go, caperathcapital.com. We've got some broadsides on them, what we call broadsides, which are our kind of thought pieces, which look a bit more at some company specific stuff, and some slightly more kind of philosophical stuff on value investing. And then there's also a bunch of links there to to articles and press pieces and whatnot. So that's probably the best place to start.
Adam, thanks so much for coming on to the podcast. It's been a pleasure to listen to you. Hopefully we can get you back in the future.
Absolutely. Yeah, thanks for having me on, John. It's been really nice talking to you, and I'd love to come back.